Are you sure you're paying the right price when you buy stocks? Your investment returns depend a lot on it. Adding a safety cushion to your investment plan is really important. Before you invest in anything, you should check if the company's real value matches its current stock price. And it's smart to make sure there's a bit of extra safety between what you pay and what you hope to gain. As people, we're always looking for opportunities, especially when it comes to investing. We're attracted to good companies and often follow what others are doing without thinking too much. But there's one thing almost everyone forgets: safety. When you're analyzing a potential investment, you're probably using estimates in a number of respects. We seldom have access to all the data, so that's the only possible way. We have to make some assumptions. But the thing with estimates and assumptions is that they can quickly become misleading. And if you have no safety net, investment decisions can leave you exposed to the turbulence of the financial markets. Think of a margin of safety as a cushion put in place to absorb unforeseen risk and/or wrong assumptions. Every year, thousands of investors take heavy losses because they have no cushion. A great checklist is simply not enough. You need more. You need safety. By the way, if you don't have a checklist, feel free to use mine. This blueprint is a great start to staying safe. However, don't forget one crucial thing. What if your numbers are wrong? There is always a chance that you have made an error, and every mistake comes straight out of your pocket. That's why a margin of safety is necessary. It is a cushion that protects you as an investor from potential losses due to unforeseen events or changes in market conditions. By using it, you will reduce the risk of losing money and increase your chances of realizing a profit. Even the great Warren Buffett has a few words to say on that topic. The three most important words in investing: margin of safety. The concept of margin of safety originated with Benjamin Graham, a legendary value investor and Buffett's mentor. His book, The Intelligent Investor, is a highly valued read for any investor and goes into detail on the value of the margin of safety. How to estimate the margin of safety. Look for well-established companies with a durable competitive advantage and high return on invested capital, among other things. Once optimism about a company's future growth are established through investment analysis, assess the intrinsic value relative to the prevailing price, and buy in at a level that includes a nice margin of safety. Example, margin of safety. As an example, let's say a stock being considered is currently trading at $50 per share. Using a discounted cash flow analysis, you determine its intrinsic value to be about $60 per share. The margin of safety in this case would be $10, or the difference between the market price and intrinsic value, $60 to $50. This represents a 20% margin of safety, $10 to $50, indicating that the investment has a lower risk of declining in value. To put it more simply, you can be off as much as 20% with your numbers, and you'd still make your desired return. The goal of the intelligent investor is to purchase, with a margin of safety, a business that is worth far more than he paid for it. Warren Buffett. If you're wondering how big of a margin of safety you need, I'm afraid I have no real answer for that. The size of the margin of safety is a subjective determination that varies among investors. For conservative investors, a margin of safety of 30% or more is considered desirable, while for more aggressive investors, a margin of safety of 20% or less may be acceptable. In the end, the most important factor is for you to feel comfortable with the level of risk you are exposed to. Conclusion: using margin of safety is key when analyzing stocks, helping us differentiate between solid investments and mere speculation. While past performance can guide future expectations, it's important not to lose sight of the significance of price. Stocks aren't necessarily valuable just because the market thinks so optimistically. By factoring in a margin of safety, we can lower risks and increase potential returns. When the market overreacts to bad news, there's an opportunity to take advantage of falling stock prices, providing us with a wider safety net. Keep an eye out for these chances to invest in great companies at appealing prices. Don't miss out on more helpful tips. Stay tuned for more investing insights. Like, share, and subscribe for updates. Raise your IQ with cutting-edge info, insights, and analysis. Visit and subscribe for free at the link below.